Hey, how's it going, guys? I know, the one single most dangerous word to say in the world of investing is guaranteed. Most of us believe if something is guaranteed, it's either a straight up scam or a boring insurance plan with virtually zero return. But what if I tell you the title of this video is not a clickbait? What if I tell you there's actually a simple strategy that you can implement right now in the stock market to guarantee double your money? That is why in this video, I will share with you guys exactly what this strategy is, why it is so powerful but very few investors actually know about it, and most importantly, how you can implement this strategy right now to significantly improve your investment returns, especially during such a volatile, depressing bear market that we're going through right now. Alright, let's get started. If you were in the stock market long enough, you would have heard this famous quote by Warren Buffett that goes, "Be greedy when others are fearful." Or how about this one by Baron Rothschild? "The way to make money is to buy when there is blood running in the streets." Yes, we appreciate all this investing wisdom in these quotes. There's no way we're gonna argue with these legends, but here is the problem. Everyone knows about these famous quotes, but very people are actually able to execute on them in the real stock market. Whenever there is a massive panic selling going on in the market, they're either too scared to press the buy button because they worry the price might go much lower, or even worse, instead of buying, they start selling their stocks to avoid further losses at the worst timing. Have you asked yourself, why is that? Why the recipe for successful investing is so simple, but there are so few people can actually follow it? Here's the real reason. The majority of the retail investors have no clue on how to exactly quantify the level of fear in the market and at which level can give investors the best risk to reward ratio to buy. So what do I mean by that? For example, let's come back to the quotes that we mentioned earlier. Yes, we know we need to buy the dips when other people are fearful and panic selling. But how do we know exactly at which level of panic it's safe enough for us to buy? Yes, we know we need to buy when there's blood in the street. But how do we know exactly which level is where everyone is bleeding in the stock market? All these fancy vocabularies that were used by these legendary investors are pretty abstract and vague. It's nice to quote them, but extremely difficult to execute on them. That is why most of the inexperienced investors only rely on the price. They believe if the stock price drops 50%, that is the maximum fear in the market because if it already went down that much, it can't get much lower, right? And that turns out to be one of the most deadly mistakes a lot of new investors have made. The price of a stock can drop 50% 3 or 4 times in a row and still won't reach the bottom, or in other words, the peak level of fear. So as a retail investor who doesn't have much insider information from the Wall Street, is there any way that can help us to quantify the level of fear in the market, translate them into numbers that we can understand, and show us exact number that signals the best time to buy the dips? Yes, there is. This is exactly where the volatility index, or the VIX, comes into play. So what is VIX and how exactly can it help us double our money? Well, I'm not going to bore you with all the crazy math equations behind this VIX index, but here are the 3 important things that you must know about VIX when you use it. First, VIX is the index that generates a 30-day forward projection of how fast the S&P 500 index price can change based on the level of uncertainties in the market. When there's a higher level of uncertainties in the market, which causes investors to become more panicked and fearful about the near future, the VIX value will go up. On the other hand, when investors are rather certain about the near future, the level of the fear in the market will become relatively low. And that's where we see VIX value goes down and stays low. Simply put, market uncertainty causes fear. Fear drives up the volatility, and the high volatility crushes down the price. In other words, VIX is the index that perfectly measures the level of fear in the market. That is why the institutional investors often call VIX the fear index. Alright, the second thing we need to know about VIX is the historical average value. This is the chart of the VIX index from 1990 all the way to today in 2022, about 32 years in total. If we do the calculation, we can get the historical value of VIX over the past 32 years is 20.8, which is this line on the chart. This is a key level to watch if you trade stocks because any VIX value below this level will signal the market is relatively safe. Investors are relatively certain and confident about the near future. This is the area where the market enters what we call the risk-on environment. Institutional investors and hedge funds usually load up large amounts of leverage when the VIX is below the average value, which is 20.8. Okay, now you probably wonder, what about the VIX value go up above this historical average level? Then that comes down to the third thing you need to know about VIX, and probably the most important part of this video, which is the normal distribution of VIX value. In finance, you can think of normal distribution as the probability distribution. We often use it to give us a broad sense of how frequent each scenario has happened in the past and how often they will most likely play out in the near future. Well, I understand that most of you guys may not be familiar with the math behind normal distribution. No worries, here's the good news. You just need to remember a couple of numbers and a few important key levels on the VIX chart, and that's it. First, the sigma value, or the value of one standard deviation unit of VIX, which is 8.3. Next, as we already know, the historical average value of VIX is 20.8. Now, we can draw a couple of key levels on the VIX chart. They are one standard deviation above 20.8, which is 29.1, two standard deviations above 20.8, which is 37.4, and lastly, three standard deviations above 20.8, which is 45.7. That's rounded up to 46. After we draw the three key levels on the VIX chart, we can see that historically, it is extremely rare for VIX to go above 46, which is three standard deviations above its average value. Why is this level so important? Because this is exactly the level what we call the extreme panic in the market. This is the level where there's blood running the street, and this is the level where Warren Buffett refers to as be greedy when others are fearful. And most importantly, this is exactly the level where the smart money investors are buying. And that's exactly what you should be doing as well. Let's zoom in closer to the most recent 15 years and let me show you why. These are all the VIX weekly closes that were above the key level of 46 from 2007 to 2022. And here are the four S&P 500 total returns after each VIX weekly close from 1 year to 5 years. Where the blank area means it just happened very recently and we're not there yet, so there's no data in it. Two important observations in this chart. First, if you buy S&P 500 every time when VIX hits above 46, you are guaranteed to make money as long as you hold it for at least 1 year, no exception. Second, the average 5-year forward return of S&P 500 when VIX hits above 46 is a mind-blowing 139%. That's right, if you buy S&P every time when VIX hits above this extreme panic level and hold it for 5 years, you are guaranteed to double your money. And take a guess, what are the majority of the average investors were doing during these times? That's right, they were panic selling. And that is the biggest and the most deadly mistake you can ever make as an investor. Knowing how to mathematically quantify the level of fear in the market and then being able to execute on your trade at the extreme level of market panic is exactly what separates the elite legendary investors like Warren Buffett from the average investors who are consistently losing money in the stock market. The ultimate secret of buying the dips is to buy when the fear index VIX hits 3 standard deviations and above. Alright, here's a summary and the main takeaways. Everyone knows we should buy the dips, but where exactly are the buyable dips that we can invest with a minimal amount of risk but a massive upside potential? The easiest way for average retail investor to quantify the buyable dips is to use VIX. The best time to buy stocks is when the market is at extreme fear level, which is when the VIX hits 3 standard deviations or above. You are guaranteed to make money if you can hold on for at least 1 year, and also you can guarantee to double your money if your time horizon is 5 years. It doesn't happen very often. Over the past 15 years, it only happened 20 times. But if you just grab these 20 opportunities, bought the dips, and held on to your stocks long enough, you could have built a life-changing amount of wealth in the stock market with this one simple technique. On the other hand, the biggest mistake you can ever make as an investor is to panic sell your stocks when the VIX hits 3 standard deviations above. Although I understand it's extremely tempting to do so when the market is in the extreme panic state, you need to avoid these mistakes at all costs. Alright, that will be the end of this video. I hope you guys learned something valuable. If you are new to this channel, my name is Vic. Thanks so much for watching, guys, and I will talk to you guys soon. Bye for now.